All right, good afternoon, ladies and gentlemen, and welcome to our monthly installment of Market Moves and Insights, where we unpack the latest headlines and market swings to help you see the forest from the trees. Now, before we dive in, I want to quickly mention DF Direct, which is our platform that's perfect for clients that want a simple, low cost, and automated way to invest. This robo advisor can make investing a whole lot easier as a US expat. So stick around till the end where I go into more detail on this. Now, as always, a quick note from our compliance team. The information presented is for educational purposes only and does not intend to make an offer or solicitation of the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any of these strategies. Now, with that being said, Dimitra, what are we talking about today?
Well, thanks, Paulina, and welcome again, everyone. Today we got a focused agenda built around both recent portfolio shifts and some of the bigger picture trends shaping our outlook for the rest of the year. We'll start with a look under the hood at how our portfolio's process works, specifically the core and satellite approach and why satellites aren't just extras, but one of the key levers we use to adapt to changing opportunities. From there, we'll get into the adjustments we have recently made and how they line up with our broader strategy of keeping portfolios resilient and well-positioned across market cycles. We'll then zero in on two of our highest conviction themes, the grid and the cyber, and unpack why these areas are attracting capital, driving innovation, and, in our view, still have room to run. And finally, we'll put the lens back for our 6-month outlook to talk about the forces we think will matter most as we move toward the year end, and how that could shape risk and opportunity for investors. So, Cam, let's start at the foundation. For those who are not as familiar with how we build and manage portfolios here at Dunhill Financial, can you walk us through the core and satellite approach and why we even have the satellites in the first place?
Absolutely, and thank you for that introduction there, Dimitri. I think this is our second episode here in this series, and I can tell you it sure doesn't feel like the second episode because a lot has gone on since our last webcast in about a month ago. So we've got quite a bit to unpack here. But we're doing things a little bit different here in today's webcast, which is just going back to basics a little bit and going through some of the fundamentals of portfolio construction and how a well-diversified and well-put-together portfolio can help our clients, weather some of those short-term storms and volatility that we often get in the markets. But more importantly, as you said, Dimitro, those are really key levers that we have at our disposal to really help navigate the portfolios through some of those turbulent moments there. So the question is, what is core plus satellite? It's not a groundbreaking concept or anything, and we're certainly not the first to have come up with the methodology here. But if my memory serves correct, actually, it was an old Goldman Sachs strategy, put together way back in the day, and since then it's taken on a moniker of its own. But as the name implies, really, a core plus satellite approach to portfolio construction really breaks down portfolios into two distinct segments. You have your core aspect, and then you have the satellite. Now, what is the core? Basically, the core of the portfolio is the foundation upon which the portfolio is built. So think basically low cost, long-term asset allocation mixes where, we can sit there and say with a good degree of confidence that we'll always maintain that sort of exposure, for a long period of time. So think, for example, your US large cap exposure, right? The US, despite all its problems, especially in the last couple of months that I'm sure the headlines have brought to bear, it is a large part of the investable universe. I think, what is it? It makes up close to 58% of the investable universe out there on a market cap basis, right? So if we look at our equity bucket there in the portfolios, it's always going to be in that core segment, right? We're always going to have a good, healthy amount of exposure to those US large caps because, even if we're, an American living abroad, or a European living in Europe, or in Asia or anywhere else, a lot of those large US companies really are international conglomerates, right? Because you think, for example, like Google or Apple, etc., they get a lot of their revenues from all over the world. Yes, they're headquartered in the US, but it's really an international company there. So that's essentially an example of what the core element of a portfolio should be, right? So these are your things that are too boring to talk about most of the time, and they'll track the markets in a general sense. Now, the satellites, that's where things get a little bit interesting. Now, satellites in a portfolio, as the name suggests, again, going back to a more astrology aspect there, is it's designed to orbit the core of the portfolio. So these are more tactical shifts, which can be used to either mitigate or complement the portfolio. And what I mean is, mitigate risk to a certain extent. And in our portfolio specifically, a great example of some of those satellite positions that we have in the portfolio are the infrastructure fund and the cybersecurity fund that we have. These two particular funds are great satellites, which we'll cover in a little bit in more detail and go through their growth story and the position they have in the portfolios. But as the name implies, the grid infrastructure and the cybersecurity funds there allow us to participate in some of these high growth stories that we're seeing in the headlines and in the wider markets, such as the AI story, which has really taken investors by storm since the beginning of the year, if not since last year, when ChatGPT really hit the scenes and almost took over every headline that you saw there in the tech space. But these particular positions allow us to get exposure to some of the underlying names that are still going to be useful in that theme without having to buy some of the more expensive parts of the sector, right? So a great example is, instead of buying NVIDIA, which is basically the poster child for the AI growth story, we're looking at ways of getting exposure to some of the names that are actually building out the data centers, right? Because we like to think AI is something, sort of out there in the cloud, and it's a non-physical entity, but somebody somewhere has to build those physical data centers. And then so you have the construction element of it, you have the prefabrication of the actual server racks, the networks and switches and everything else that goes into getting a data center up and running, in addition to those AI chips. But again, you get exposure to that theme, but without necessarily having to buy more expensive names in the wider gambit there. And by having that satellite approach and pulling those certain levers, essentially what you end up with is a more resilient portfolio, because the overall price to earnings, and just to break it down for our audience there, price to earnings is basically a metric which we use to gauge how expensive a particular segment of the market or a portfolio is. But by having some of these tactical elements in there, we're able to still participate in that growth story, but again at a much lower valuation. So if we do end up getting pullbacks in the wider market, which we will at some point, the portfolio is better positioned to weather some of that storm.
Well, right. So that's the framework. A solid diversified core, which is complemented by satellites that let us capture opportunities more dynamically, as you said. So it gives us a little bit of more flexibility. Well, all right. So speaking of those satellites that you just mentioned, and some maybe any other, we made a few adjustments recently to our portfolio. Could you please walk us through the latest portfolio changes and what's driving them?
Absolutely, and there's been a number of changes there in the portfolio, particularly on the satellite element there, as you mentioned, Dimitro, and we've been really active in that part of the portfolio there, namely because a lot of things have changed since the beginning of the year till now. I mean, since our last podcast that we did almost a month ago, a lot of things have changed between now and then. And as the data continues to come in and evolve. Basically, we want to make sure our framework, keeps track with it. I.e., we're not static. We are dynamic and respond accordingly to how the data comes in. And I think the biggest story for this year has been currencies, particularly the weakening of the US dollar there. So early on this year and throughout the quarters, what we did is trim back some of our US exposure and increase the international side of things, particularly on the equity sides, because as some of the policies and such were coming through, it became very evident and clear that not only did international markets, particularly Europe, finally have a catalyst, just a couple months back with the Germans approving that historical spending bill there. But more importantly, valuations have been attractive for a very, very long time outside the US. And we started to capitalize on some of those aspects there and shift up into a more international stance in the portfolio, which, combined with the growth opportunity plus the currency has, been a great opportunity. More importantly, though, I think on some of the fixed income side of things, that's where we've been very active as well. Fixed income is typically meant to represent the safer part of our portfolios, especially for clients, right? It's the part that's going to provide you that income for long-term retirement. It's going to, in normal times at least, it should provide a ballast, when markets do experience some bouts of volatility. And what we're doing to complement our existing fixed income stack there is introducing more international currency specific exposure. So for many of our clients in the UK here, as well as throughout Europe, they'll start to notice a little bit more international exposure within their bond allocation there. And that's purely just to make sure that the safe part of the portfolio, it's safe not only in the asset class, i.e., staying in fixed income, but it's safe in the domestic currency that clients will eventually be spending in. For example, a client in Europe, their day-to-day expenses are in euros. They buy their bread in euros. So making sure that the currency is aligned in regards to their income needs is something that we keep a very close eye on. So those have been some of the key shifts there in the portfolio. Again, commodities is another hot topic here, which we'll address a little later. I know you've got that on the agenda here today to cover, Dimitro. But again, commodities is also one of the positions in the portfolio which fall into that satellite bucket there that we've got. And we're continuing to maintain that position and potentially even look at increasing it because of the confluence of data that's coming out. But again, I don't want to steal the thunder there, so we'll definitely cover that in the later section there. But I think those are some of the key shifts that we've made in the portfolio there. And as the data continues to evolve in the remainder of what remains of 2025, we'll be shifting the portfolio accordingly.
All right, well, welcome. Thank you very much. I believe that gives us a pretty good picture of how the portfolio has evolved. So you already touched the boosting international credit and increasing our global and some thematic exposures. And actually, speaking of thematics, two names that keep showing up in our portfolios regardless of the market news are greed and cyber. You already mentioned them a couple minutes ago, and I believe right now is the best time to dig into those. Could you please tell us why do we continue to hold these positions and what makes them stand out in the current environment?
Absolutely, and that's an excellent question there, Dimitri. And I think to add to what we were discussing earlier on a couple minutes back, if we look at a lot of the policies and some of the headlines we're seeing come out of the current US administration, if we try to filter the noise, which it's a big task, there's a lot of noise out there in the headlines, especially, and I think creating chaos in the headlines is something this current administration excels at. If not, it's a pastime of theirs. But if we really distill some of the policy shifts and headlines we're seeing, at its core, the US is trying to pivot away from a service-driven economy and more into a industrial economy, i.e. making things on US soil. Now, how successful that's going to be in the coming years, that's not for us to decide. That's for the economic advisors, etc., to put those policies and gears into effect. But what it really means is if the US is very serious and focused on getting some of this manufacturing back on shore, whether it's advanced manufacturing like AI chips and creating the fabs that make those semiconductors here. Take Intel, for example. It's been in the headlines for the wrong and the right reasons the last couple of weeks. But if we take all of those confluences into consideration, infrastructure, particularly in the US, is going to be a key driver of growth going forward, right? A lot of the growth in the last 10, 15 years have really been service driven in the US, and it's been to a good success, right? I.e., the US has had good success in being a service-driven economy. It's not to say that it's impossible to pivot back to an industrial-based economy, but there's certain policies that have to, come into effect before, ground can be broken on a new manufacturing facility or factories to be set up, right? It's just the economics of it is that the US isn't as competitive compared to its global peers, especially when you take into account subsidies and everything else. But anyway, we're getting off track there. Coming back onto the infrastructure aspect there is great opportunities in a lot of those names that provide core infrastructure, whether it's on the data centers, as I was mentioning earlier, or building the roads and ports and bridges, etc., that will need, whether it's for national security or supporting this reindustrialization. So taking all that into consideration, it's a good theme to have a small slice in the portfolio, because not only does it insulate you a little bit in regards to this whole reshoring effort, but more importantly, it allows you to continue participating in some of those key growth stories like AI, like EV adoptions, electric vehicles, etc., and battery manufacturing, and all that good stuff. But making sure you're on the side of the US, i.e., if they're going to be throwing billions around to enact some of those policies, guess what? Some of those companies are set to benefit. It's probably a good idea to have a bit of exposure to them. And again, that's why we're really positive on infrastructure as a sector there, not only in the US but globally, right? Take Europe, for example. It's coming to the realization that as part of its NATO 5% defense commitments, it's going to have to reindustrialize. It's going to have to build more ammunition factories on European soil. It's going to have to build more, complex weapons manufacturing systems, whether it's, satellites or tanks and such. So all of that is supportive of the theme itself of reindustrialization, reshoring, etc. And that's why we continue to believe, it's a good theme, for the foreseeable future. Cybersecurity, again, same premise, right? As more and more things become digitized, and especially with AI, where essentially vast swaths of data are just being ingested and then spit out for responses, where does cybersecurity fit into that, right? Again, people, not only individuals, but corporations are going to be spending a large part of their R&D into making sure a lot of those large language models or data sets that they're using, that they are secure, that they are insulated from cyber attacks and espionage, etc. And again, another theme which gives you exposure to tech, but at a slightly more defensive valuation, right? Because instead of just buying the Magnificent Seven, which it already forms up like 40% of the S&P 500, but you get to miss out on some of those other names that are still part of the tech complex, but they don't always end up in the headlines, right? So again, it's one of those satellite themes that we have in the portfolio, where we're not only able to bring the valuations of the overall portfolio down to a slightly more defensive manner there, but continue participating in some of these key growth drivers for long-term growth.
Well, all right. So I think right now everybody already understood that you really like infrastructure and cybersecurity industry. But I would suggest to maybe take a step back and talk about the bigger picture. What do you expect to shape the economy and the markets in general over the next 6 months?
Yeah, I wish I had a crystal ball, because if I did, I'd probably be somewhere in an exotic island with the a nice yacht. But the real takeaway is that the next couple of months for the year, it's going to be a bit of a repeat of the last 7 to 8 months. And what that means is uncertainty. And uncertainty in the way that it's structural, right? Because a lot of the headlines that are coming out with the tariffs, yes, some countries have negotiated and they've got their tariff rates set in stone. Others, the can's been kicked down the road for another 90 days. And when those 90 days expire, it might be another 90 days, who knows, right? A lot of that policy making is very hard to disseminate, i.e., we used to think there was some logic behind it, or i.e., like a rhyme or reason behind some of those policy shifts. And originally, it was to address the deficit, etc., that the US has with its various trading partners. And over the last 7 to 8 months, it's devolved into its own little thing. But outside of that uncertainty, I think the two biggest drivers for the remainder of the year is going to continue to be currencies and inflation. And we'll touch upon currencies a little bit, because when we were discussing some portfolio adjustments in the earlier part of this segment here, Dimitri, I think one of the things we forgot to cover or give any love to was the emerging market complex. Emerging markets have really been an unloved sector for a very, very long time. And what I mean by that is pre-COVID, basically, there was a lot of growth opportunities. After COVID, some of the economies in the EM complex recovered, others struggled, but the large sort of elephant in the room there, or the large dragon, I should say, being China, just couldn't get itself, back into high gear after COVID and get back on its feet with the recovery. However, in the last 7 to 8 months, we've seen a severe weakening in the dollar. A weaker dollar is very beneficial to emerging markets, similar to how we've seen a weaker dollar benefit Europe and some of the Western economies outside the US. It's equally, if not more, beneficial to emerging markets, just because it makes their borrowing costs and financing costs much cheaper, because they more often than not tend to finance in dollars. I mean, take, for example, the MSCI EM index. It's up about 16% for the year, which is more than the S&P 500 which is, I think, about 9 or 10% for the year. And then the developed market index is sitting at sort of 13 or 14% there, basically. So really, I think the next couple of months and coming into 2026, emerging markets are going to start to play a bigger role, not only in our portfolios, which we'll cover a little bit later, but I think there's real growth opportunities there, not just from a currency perspective. Valuations still remain dirt cheap, but again, the biggest thing that's causing a bit of uncertainty there for that theme to really take off is the politics and such, right? If this tariff talk with China doesn't get resolved, it's not going to be positive for EM, right? So again, there's a lot of different factors out there, and right now we're just continuing to see how the data is coming in and then tacking accordingly. I mean, just this morning, actually, I was reading a survey from Bank of America that showed that fund managers in general are holding about 37% more EM exposure heading into this year, and that's the highest it's been on record for 2 years now. Is that because they're positioning because of the weaker dollar and they continue to expect it to continue for the rest of the year, or is it something else? We don't know, right? But what we do know is valuations continue to remain very, very attractive in EM. Growth opportunities do exist there, particularly in the small to mid cap space in the EM complex there. And, it's something to keep an eye on. The other part, as I mentioned, inflation. All these tariff talks, regardless of which side of the political spectrum you sit on, but we won't touch politics too long here, just for the sake of time as well. I think we're getting pretty close to our cutoff here. But really, inflation is going to be if not the most important conversation piece for the next 4 months or so. If we had US inflation come out yesterday, sorry, I should say, and it came in at 2.7%. That's the headline there. Now, it doesn't seem that bad, right? It's close enough to 2%. But what's more important is if you look at core CPI And core CPI, just for our audience there, core CPI strips out food and energy, right? So we're looking at just basically the more sticky items like services and goods. Guess what? Those are some of the two segments that are heavily impacted by tariffs, because if you slap 40% tariffs on China and all of your appliances like fridges and dishwashers, I should say, and other various home appliances come from abroad, it's going to be more expensive to buy at the various different retailers there. And then if we look at that core segment there, it's at 3.1% versus 2.9% for the month prior. So we're starting to see that inflation uptick come through in the numbers. Now, whether the numbers are accurate or not, I'm not going to touch that on this episode here, but what it's showing us is the direction of travel. And quite clearly, the direction of travel is heading in the wrong direction. Same story in the UK. You know, in the UK, we're slightly worse for wear. The latest inflation figures here in the UK, we're sitting at 3.6% for July's number versus 3.4% for the month prior. Europe, I think, is doing the best out of the bunch there, which is they're sitting at 2.3%. But again, it's slightly higher than the month prior at 2.2%. Now, as these tariffs start to ripple through the economy, I think the US is going to be much more affected than the UK and European Union, just because those tariffs are really going to be inflationary for the US and deflationary for everybody else, right? Because the importers are paying the tariffs, despite what anyone would make you believe. And as that starts to flow through into the economy, what we're fearful of, I should say, is that we might end up in a 1970s and 80s type of environment, where inflation peaked, came back down, everybody started celebrating prematurely, only for it to shoot right back up. And that's what we fear, you know, the current setup is heading towards. Again, we're not predicting we're heading back up to 10% inflation, but if we are, you know, some of the tools that we have in the tool shed there, and particularly in that satellite bucket that we were covering earlier on in this webcast, Dimitri, like those commodities, you know, that's really going to be the place where the portfolios are going to get a lot of their ballast from, right? Because if we end up in another 1970s and 80s, commodities, a broad-based basket of commodities is really going to be the place to be. But again, we're continuing to assess how that data is coming in, especially on the inflation front. And you know, as it continues to increase or head in the wrong direction, you know, clients will start to see, excuse me, that commodity position in our portfolios ebb and flow accordingly as a function of CPI. But really, in essence, those are the two key drivers for the remainder of the year. Naturally, something else could be tweeted between now and next week, so who knows? But I think the key things to watch out is the US dollar and its trajectory, and how inflation shapes up across the developed world.
All right, well, thank you guys so much. And as we wrap up and before we sign off, I promise I'd come back to what I mentioned at the start, which is we know that investing abroad, living abroad, often feels like it's full of barriers with high minimums, complex tax rules, and the fear of making a wrong move. Now, as I said, we built DF Direct to eliminate all of these barriers. So in short, it's our low cost, no minimum investing platform designed specifically for US expats. It gives you access to US tax compliance investing with portfolios matched to your risk level and also managed by Dunhill Financial. And the best part is you don't have to be an expert or have a fortune to get started. All you need to do is visit dfdirect.com or drop us a message at info@dunhillfinancial.com, and we'll be happy to get you started. And once again, I'd like to thank you all for tuning in, and until next time.
Thank you so much for hosting, Paulina, and thank you so much, Demetria, for those excellent questions. More importantly, thank you to our audience for tuning in, and have a wonderful rest of the day, everybody.
Thank you very much, everybody.